Well, we've made it to 2026. It's mid-January. I want to catch you up on the Austin market. Our headline story for today are mortgage interest rates about to go through a bit of a roller coaster. I'm going to bury the lead on that one. I'm going to bring that story to you here in a few minutes, so stick around. We're going to start with some of the statistics as we start the new year. Austin right now, considered a balanced market. A lot of that is because of inventory that's come out of the market. Think of withdrawns, expireds. You start the year over. We're typically at our lowest point right now of inventory for the entire year. So we finished last year. You can see the supply curve down here on the left. We were highly, well above where we were in 2024 and significantly above where we were on a 10-year average. We are still in high supply time. So expect we're going to see supply stay higher. I'm going to show that to you on the next chart. If we go over to the demand side on the right, we were pretty neck and neck with last year. But again, that is below the 10-year average. So less buyer activity, more listings equals typically longer days on market and price either flat or softening. This is a look at 2 years of inventory. So the green are active listings, and it starts on the far left, which is January 2024. It ends on the far right, which is December 2025. So, and then closed sales are the blue marks at the bottom. And again, you typically see them go up in the spring and then soften throughout the year, go up in the spring, soften throughout the year. We did get a nice little pop at the end of the year in December, so that's a good sign. We saw rates come down a little bit. And also you have a lot of November closings that kind of get pushed into December. So it drops November and raises December. So we see that. But look at inventory. If I go back to January 2024, we had 9,000 single family homes on the market. If I go to the beginning of 2025, we had 10,600, so about 1,600 more homes to start last year. And now if I come to this year, we're at about 11,200. So again, about 2,200 more homes starting the year on the market than we had 2 years ago. Look at where we peaked out on supply last year, 16,000 pretty much homes on the market. We had peaked out in 2024 at 13,700. So again, until demand comes into the picture or something changes, we're going to continue to figure out how high can supply go before we get back in balance. We have not reached it yet, but ideally, interest rates coming down could make an impact, and we'll talk about rates here in a second. Finally, this is historic sales price trend. And again, this is a 2-year look. If you didn't really know any of the numbers and you look at it, it's kind of flat, and that's not untrue. So if I go back to January of 2024, or I'll go to February. Let's see if I can get a January number. We'll start with February. Median home price was $438,000. So as we go through 2024 and we go through 2025 and we end the year in 2025, our median home price was $435,000. So it's pretty equal to what it was 2 years ago. And yes, individual neighborhoods and pockets and the market as a whole, we have seen it soften. But generally, as a market, the median home price is staying put. And again, look at each month. It's pretty volatile. It's going up and down depending on closed sales. So, but for now, I'd say we're staying kind of in this 425 to 440 median home price range. And that's been with interest rates in kind of the sixes, maybe touching 7 the last 2 years. So if rates can come down, we'll see if that changes. All right, well, let's get to rates. So last week, President Trump ordered his representatives, which most likely is either going to be the Federal Reserve or it's going to be Fannie Mae and Freddie Mac, to buy $200 billion in mortgage bonds. Well, what does that do? Remember how low interest rates got after COVID when the government intervened and bought mortgage-backed securities. In fact, they became the biggest buyer of mortgage-backed securities. I think they bought over $500 billion in mortgage-backed securities. Well, if you create artificial demand, then that makes the price of the mortgage-backed securities go up. And when the price goes up, the interest rate comes down. And so the idea is if they can intervene again and buy $200 billion in mortgage-backed securities, then they can influence the direction of mortgage rates. The question is, who's doing the buying? How long are they going to do the buying? And what happens when they stop? So I think for the short term, and let's say short term is 6 months to 2 years, somewhere in this window, let's say this activity happens, there's a good chance we might see rates trickle lower. That would be good for buyers and borrowers. I'm curious what happens when this ends, because anytime you artificially do something, you have to stop it. And then, of course, we've seen all the repercussions after doing that. However, just a few days later, Department of Justice opens a probe into Federal Powell, who heads the Federal Reserve, a criminal charge basically based on some testimony he provided Congress about the renovations of the Federal Reserve building. But many are speculating that this is just another way to kind of stick it to the Federal Reserve and kind of try to influence them to lower rates. But of course, that has a backlash effect because Wall Street and the bond market is like, hey, we want the Fed to be independent. We don't want them to be politically influenced. And so it has the opposite effect. So the first story made the bonds come down on the 10-year Treasury. This second story is making the bonds go back up. So again, hard to tell where they're going to go with that. This is as of Friday. So remember, it's Monday, the 12th. This is as of Friday, the 9th. Rates had come down to their lowest point in 3 years. And many buyers were getting rates maybe on Friday in the high fives, especially on a conventional loan. It was great. So we're seeing rates come down, but this is before the Department of Justice story, which just broke yesterday and is making news this morning. So we're going to be watching that 10-year Treasury. We're going to be watching the 30-year fixed rate mortgage. So if we go all the way back to May of 2022, that was the end of, let's call it, the COVID crazy pandemic buying cycle. Rates were shooting up. You can see that here on the left. We started May in the fives and then just rocketed up into the sevens. And of course, we weren't sure how long it was going to last, and it just kept going. We peaked out in October 2023, almost 8%. And since then, it's just been a rocky road to get them back down. But this year's been the steadiest, and we've gotten all the way down to the lowest 6 number. We're going to have to see if rates can drop below 6% this year. I think a lot of that's going to have to do with these headlines. What are they going to do? How much are they going to interfere or not interfere in the mortgage-backed securities market? So pay attention to that. It's an interesting way to start 2026. You're kind of fighting yourself, in my opinion, with these two stories. So let's see what happens with rates. All right, if you are a seller right now, you may have a nice little window. It's small. You still have a ton of inventory to compete against, but you're at the lowest amount of inventory you may compete against this entire year. So we're hearing a little bit of pickup. You always have New Year's resolution buyers. You're getting a wave of buyers kind of coming back out to the market. So we'll see if that creates some increase in sales. And on top of that, you're seeing lower rates. So a few minor tailwinds for the sellers. If you are a buyer, really rates could be the story of the year. If they can end up being lower, that's going to be a great tailwind for you. I think inventory will remain high. That's going to be a tailwind for you. The challenge is going to be if rates do come down enough that it creates a little more activity, then I expect you're maybe not seeing quite the deals that you would have seen maybe the past few years. If there's a little more competition, if houses start selling a little faster, then you'll have to react a little faster and maybe make some stronger offers to the sellers. Again, all speculative. We're going to have to see how 2026 plays out. Anyways, I hope you find these videos helpful. You can watch our YouTube channel each and every week. You can click that subscribe button at Ryan Kelly Group. And of course, if you know somebody looking to buy, sell, invest, or finance here in Austin in 2026, we want the opportunity to chat with you. Anyways, hope you guys had a great holiday. Sorry I didn't have a video the past couple weeks. We're back on track and talk to you next Monday. Thanks.